Here is the scenario we're working with. Here's our timeline. This is the month of August. On August 1st, we began our period with, 20 units at $91 each. So those are purchases that happened in the previous month that went unsold and rolled over to the current month. So $91 times 20 is $18.20. And then on August 3rd, we have a purchase, 15 units at $106 each for a total of $15.90. We have our first sale on August 7th. We've sold, 20 units, 5 times 4, 20 units for $130 each for total revenue of $2,600. And then we're back to purchase. On August 17th, we bought 20 units at $115 each. Another sale, August 20th, we sold 15 units at $140 each. $2,100 is our total revenue. Another purchase on August 25th, 15 units at $125 each for a total of $1,875. Our last purchase, just 5 units at $119 each, $595. And then we've got our final sale on August 30th. It is 25 units, big sale, 25 units at $150 each. So that is $3,750 of revenue. So here's our timeline that we're going to be working with in this problem. This is periodic weighted average. First, let's look at our cost flow. This is that X. This is how we're going to analyze the cost flow through the inventory account. We're going to look at the inventory account 2 ways. So one account, but we're going to look at it as units flowing through the inventory account. And more importantly, because this is how the inventory account is recorded, dollars flowing through the inventory account. Units. We're going to start with beginning inventory. That is 20 units, 4 times 5, 20 units. And then we're going to look at the units we purchased. There's 15 units and 20 units. So that's 35. And another 15 units. So that's 50. And another 5 units, that's 55. So we've got 75 units available for sale. Those went to one of 2 places. They were sold or they remain unsold in ending inventory. So we can look at our sale, and that is 20 units sold there and 15 there. So that's 35 and another 25 units sold here. So 35 and 25 is 60 units. So we sold 60 units. Of the 75 that were available, we sold 60. That means our ending inventory is 15. There's our cost flow in units. We can do cost flow in dollars as well. Same way. Beginning inventory, 1820. Our purchases. Get the calculator out here. That's 1590 and 2300 and 1875 and 595. 6360. Our purchases. 6360 plus our beginning balance of 1820. 8180 is what we have available for sale in the month of August. So that 8180 was either sold or it remains in ending inventory. We don't know the dollar amounts for these two. We have to go through the weighted average method to figure out what the dollar amounts are. So let's do that now. The periodic method says we're just going to do this calculation one time at the end of the period. So we're going to figure out our total dollar amount available for sale and our total units available for sale. And then we find the average. So we've already done that up here. Cost is going to be stated as cost per unit. So our weighted average formula is total cost over total units. And so it's 8180 over 75. The two available for sale numbers, dollars and units. So 8180 divided by 75 is 109.07. That's our cost per unit. That's our cost per unit. So the ending inventory was 15 units at 109.07 each. I'm going to round it to 1636. And we had 60 units at 109.07 each, 65.44. We can double check. This doesn't always work out properly when we're using the weighted average method. But if we add 65.44 and 1636, we should come back to our available number, and we do 8180. So our journal entry, we're just going to do one journal entry at the end of the month. We have to record our revenue. So let's say this is a cash sale. And The credit is, we'll call it sales. Sales, revenue, those accounts are interchangeable. And then we just add up what we brought in here in revenue. So that is 2,100 and 2,600 and 3,750. 8,450 is our revenue. We always have to record 2 journal entries when we are a merchandiser making a sale. So the second journal entry is to record the cost. And we just calculated that the cost is $65.44. So on August 30th, we're going to record the expense, cost of goods sold for $65.44. And the credit is going to be merchandise inventory for the same $65.44. This represents moving the actual cost of those 60 units out of the asset account and over to the income statement, the expense account called cost of goods sold. As long as we're doing journal entries. Here's what all the purchase journal entries look like for those 4 purchases. We don't need to record anything for beginning inventory because that's already in our inventory account. Those purchases were recorded last month. But for the month of August, on August 3rd, we bought 1,590 of inventory. August 17th, it was 2,300. August 25th, 1,875. August 28th, 595. Those are our purchases. Those are the journal entries for our purchases. That is periodic weighted average.